Okay, so it is April 23rd, 2026, and if you told me a regulated utility company would be out here behaving like hyped up AI tech stock, I probably wouldn't believe you, but here we are. NextEra Energy, ticker NEE, just dropped their first quarter results, and the narrative is honestly wild. Welcome to Earnings Unscripted.
Yeah, it is definitely not your grandfather's Florida utility anymore. But look, the numbers themselves are a bit of a contradiction. On the surface, it looks great. Adjusted EPS came in at $1.09, which is up roughly 10% from last year. Top-line revenue hit $6.7 billion. But then you look under the hood, and operating income actually fell, down roughly 2%, margins compressed from 36% down to about 33%. So they are selling significantly more power, but somehow keeping less of the profit on the operational side.
Which is exactly the kind of paradox we love to pull apart here. And just a quick housekeeping note before we go diagnosing those margins. This is all just our personal opinion, definitely not financial advice, so please don't restructure your portfolio based on our banter. But Miro, despite those shrinking margins, the market absolutely ate this report up today.
They completely ignored the expense side. Yeah, the stock gapped up right at the opening bell from yesterday's close of 90, and it didn't just pop. It initiated this sharp, sustained rally all morning and then just parked in this elevated range around 96.50. They closed up almost 4% in the regular session and just kept drifting higher in extended hours to almost a 7% gain. The street is looking strictly at the demand story.
And you can see why, considering they added a record 4 gigawatts of renewables backlog just this quarter alone, which makes total sense when you realize they are literally teaming up with NVIDIA to turn hyperscale data centers into reverse emergency batteries. Like during a winter freeze, they want to pause the AI compute and push that data center power back into the public grid. It is a completely surreal shift in what a power company even does.
It is a very clever feedback loop, but for me, the absolute standout was that U.S. and Japan trade deal. It's honestly unprecedented. The government basically tapped NextEra to build 9.5 gigawatts of gas generation for data centers in Texas and Pennsylvania. But here's the trick. They deploy zero capital. The sovereign funds cover it. NextEra just executes the build and collects the operational fees. The CEO literally called it an infinite return.
Okay, right. Infinite returns sound amazing on an earnings call. But then you look at those ballooning operating expenses you mentioned earlier, up 18% year over year, and you realize, wait, you still have to actually find the pipe fitters and the welders to build out all this infinite return infrastructure in the physical world.
Exactly. The money is abundant right now for these mega projects, but specialized labor is the hard bottleneck.
All right, well, that seems like the perfect place to start digging. Let's get into the details.
Right. So let's look at that labor piece, because everyone assumes the bottleneck for this massive energy transition is, raw materials or transformers, supply chain stuff. But Ketchum, the CEO, was very explicit on the call. He essentially said the biggest constraint he sees in the market right now on getting gas built faster is just labor, specifically the EPC contractors.
Right. Engineering, procurement, and construction. The actual physical builders.
Yeah, the folks welding pipes and pouring concrete. He pointed out they used to have maybe 9, 10, 11 of these massive contractors bidding against each other. Now there are far fewer. All those specialized workers are basically locked up building LNG export terminals down on the Gulf Coast.
Which is a very real physical limit.
Mm-hmm.
So if you are NextEra and you just signed the supposedly zero capital mega deal with Japan and the U.S., you still have to construct 9.5 gigawatts of new generation. You cannot just AI your way out of needing welders.
No, you really can't. You can design the best software in the world, like that Grid Composer app they are building with Google, but physical infrastructure requires physical sweat. And when labor is that tight, the contractors have incredible pricing power, which actually brings us right back to the margin squeeze you noticed earlier.
The 18% spike in operated expenses. Oh, sorry, wait. I think operations and maintenance specifically jumped 21% year over year.
Exactly. Your top line is growing, but the baseline cost of running the machine is eating a lot of the upside. And that is even before factoring in the unified depreciation rates they just got approved down in Florida.
Okay, yes. But O&M costs, that's just normal inflation and labor tightness, right? The actual glaring issue on their balance sheet is what is happening with the yieldco, with XPLR.
It is getting ugly.
NextEra Energy Partners, which, let's just point out, they conveniently rebranded to just XPLR recently. It feels like a very quiet attempt to decouple the corporate name from a sinking ship.
It is textbook optics management. If you dig into the 10K, the whole thing is a mess. The parent company had to take a $0.7 billion impairment charge this quarter on their XPLR investment. Just completely wrote it down.
Wow, $700 million. Just vanished.
Yes, the entity suspended their unit holder distributions, the trading price absolutely collapsed, and as a cherry on top, an appeals court just revived this really nasty political campaign finance class action against them.
Right, the 11th Circuit suit. So that is back in the discovery phase now, which just generates terrible headlines right when they're trying to sell this ultra-modern, clean tech AI image to hyperscalers.
It is the classic corporate divergence. You have the unregulated arm, NEER, out there signing infinite return data center deals with sovereign wealth funds, and meanwhile the financial vehicle they use to fund previous growth is literally fending off fraud lawsuits.
But are they walled off? I mean, structurally, because a $700 million write-down says the wall is pretty porous.
To a degree, obviously it hits the GAAP net income hard, but the beauty or the reality of NextEra is that their regulated utility arm, Florida Power and Light, is a cash printing machine. They added 100,000 net customers year over year. Their regulatory capital employed grew almost 9%.
So the Florida monopoly basically subsidizes the volatility everywhere else.
That is exactly the model. FPL just casually drops almost $1.5 billion in net income this quarter to anchor the ship.
Okay, so they have the Florida safety net, but looking ahead, you have to wonder how Longway can juggle all this. You have soaring operational costs, these massive vanity projects that still require impossible-to-find human labor, and this huge recontracting cliff coming up in a few years.
Yeah, roughly 6 gigawatts of renewables are coming off contract by 2032. It's a lot of moving parts for any management team.
So where does all this leave them heading into the rest of the year?
Confident, honestly. I mean, they completely reaffirmed their full-year guide. They are targeting the high end of that 392 to 402 adjusted EPS range, and then they casually projected an 8% plus growth rate all the way out to 2035.
Which is a very long time in utility years, or, well, I guess they are basically a tech stock now?
Right, but that is the whole friction. They are projecting demand like a tech firm, but they still have to pour concrete. And for me, the real unknown to watch next quarter is actually that U.S.-Japan mega deal.
Because the ink is not quite dry on that yet.
Exactly. The press release sounded great, but the CEO admitted the definitive agreements are still maybe 2 to 3 months out. So I will believe it is an infinite return once I see who actually eats the cost overruns when those EPC labor shortages hit.
Oh, fair point. If the build gets delayed, somebody's paying for it. It just feels like management is asking investors to look at this beautiful AI horizon and just sort of ignore the grind happening right now with XPLR and those margin constraints.
They are. I think they're betting the hyperscaler demand is just so structurally massive that it washes away all that near-term turbulence.
I mean, it's probably a smart bet when you have a Florida utility monopoly basically bankrolling your casino chips.
Highly regulated casino, yes. But the house usually wins.
Let's hope so. All right, I think that is a wrap on NextEra's identity crisis. Thanks for hanging out with us today, guys. We'll see you after the next call. Just before we go, if you want these breakdowns to show up automatically whenever a big report drops, feel free to follow the show. And a quick transparency note that this podcast is generated with the help of AI, which we use to chew through all those massive SEC filings so we can just focus on the actual story. We are always looking for feedback, so please shoot your ticker requests to earningsunscripted@datamadness.ca or find our X link right in the show notes.
See you guys next time.